The final trading day of 2025 arrived quietly across Asia's financial centers. The early morning light revealed a sense of calm, with the usual rush of traders and commuters replaced by a more subdued energy. In cities like Hong Kong, Singapore, and Sydney, the financial districts seemed to pause, reflecting on a year that had been anything but ordinary. There was no dramatic surge, just a patchwork of small gains and minor losses. The numbers flickered quietly on digital boards, signaling a market content to drift rather than make bold moves. Investors and analysts alike watched the screens, knowing that the real stories of the year had already been written. In Hong Kong, Sydney, and Singapore, markets edged down as traders wrapped up for the holidays. Desks were cleared, and the usual chatter faded, replaced by the soft sounds of people preparing for a well-earned break. The mood was reflective, with many looking back on the challenges and triumphs of the past 12 months. With Tokyo and Seoul already closed, trading volumes were thin and the usual buzz was missing. The absence of these major players left the region's markets quieter than usual, underscoring the sense that the year was truly winding down. Shanghai, Taipei, and Mumbai managed modest gains, hinting at local optimism amid the calm. Traders in these cities found reasons to be hopeful, buoyed by positive economic signals and the promise of a fresh start in the new year. The day's performance was more a footnote than a finale, capping a year of strong growth. Analysts reviewed charts and graphs, noting how the region had weathered global uncertainty and emerged with resilience. The lack of major news kept things subdued. Most investors were content to tidy up positions and look ahead. Portfolios were reviewed and final adjustments made, as everyone prepared for the opportunities and challenges that 2026 might bring. The slight declines weren't seen as trouble, just a natural pause after a turbulent year. For many, it was a chance to catch their breath and reflect on the lessons learned from months of volatility and unexpected turns. Small gains elsewhere reinforced the underlying strength that defined 2025. Even in a quiet session, the resilience of Asia's markets was clear, with investors quietly celebrating the year's steady progress. As the sun set, attention shifted from the day's minor moves to the remarkable journey of the past 12 months. The city lights flickered on, illuminating a region that had navigated uncertainty with determination and adaptability. The markets took a collective breath, closing the year on a tranquil note. As the closing bell rang, there was a sense of quiet satisfaction, a recognition that, despite the challenges, Asia's financial centers had ended the year stronger and more united than before. While stocks coasted along with little drama, the commodities market was anything but calm. Silver prices experienced a dramatic jolt, plunging nearly 9% on the final trading day, catching many investors off guard and sending ripples through the market. Just days earlier, silver had soared to a record $84 an ounce, fueled by a surge in demand and speculative buying. But as the year drew to a close, profit-taking and the thin, holiday-affected trading environment sent prices tumbling to $71 in a matter of hours. Gold, too, slipped, though its decline was less severe. The yellow metal continued its retreat from recent highs, reflecting a broader cooling in precious metals after a period of intense gains. This sharp drop signaled a shift in investor sentiment. Many were moving out of traditional safe havens like silver and gold, feeling more confident about riskier opportunities as the economic outlook brightened. The steep fall in silver was a textbook case of year-end profit-taking, made even more dramatic by the low trading volumes typical of the holiday season, when many big players are away from their desks. Volatility in precious metals was on full display. Prices can swing wildly in response to even small shifts in sentiment or trading activity, especially when markets are thin. Importantly, this move wasn't about silver's underlying fundamentals. Instead, it reflected the natural rhythm of markets correcting after rapid, unsustainable gains, a healthy, if sometimes unsettling, part of the financial cycle. For many long-term investors, the outlook for silver remained positive. The day's events served as a vivid reminder, though, of just how quickly fortunes can change in the world of commodities. Rather than a crisis, the slide was seen by most as a sign of prudent investors rebalancing their portfolios before the new year, locking in gains and preparing for whatever comes next. It was a fitting example of how quickly sentiment can shift in commodity markets, and a reminder that in the world of precious metals, change is always just around the corner. December 31's subdued trading stood in stark contrast to 2025's powerful rally. The year rewarded those who stayed invested, with major indices posting impressive gains. The quiet final day was simply a calm after months of growth and recovery. Even markets ending with small losses, like Hong Kong and Sydney, had strong annual performances. Thin volumes and closed exchanges meant little momentum for big moves. The market drifted to the finish line, content after a successful run. Despite challenges and uncertainty, optimism and growth prevailed. The market climbed a wall of worry, reaching new heights. The peaceful close was a well-deserved rest for investors after a year of rebuilding wealth. The story of 2025 was one of resilience, not defined by its quiet ending. Wall Street's slight dip on December 30th set the tone for Asia's quiet finale. U.S. indices closed a bit lower, sending a ripple of caution across the Pacific. The minor pullback wasn't driven by bad news, just a pause after a strong run. Like Asia, the U.S. was on track for solid annual growth, with the dip seen as healthy consolidation. Analysts described it as a subdued but fitting end to a strong year for stocks. Wall Street's mood often sets the psychological tone for global markets. This time, the message was calm and finality. No panic, just a market slowing to a walk at year's end. Asia mirrored this quiet signal, leading to a synchronized, peaceful close worldwide. The year ended not with a bang, but with a collective exhale. One of the main reasons for Wall Street's recent dip was growing anxiety over the meteoric rise of AI stocks. Investors, who had watched these companies soar to unprecedented heights, began to wonder if the rally could last. The speed and scale of the gains left many market watchers uneasy, questioning whether the fundamentals could keep up with the hype. Throughout 2025, AI-related companies experienced a massive surge, driven by a wave of investment and widespread public excitement. New startups entered the market almost weekly, and established tech giants doubled down on artificial intelligence, hoping to capture the next big breakthrough. The buzz around AI was impossible to ignore, with headlines touting revolutionary advances and billion-dollar valuations. But as the year drew to a close, concerns mounted that valuations had soared too high, too quickly. The market's rapid ascent began to plateau, and some analysts warned that a correction might be on the horizon. The fear of a bubble started to creep in, making investors more cautious. Investors started to question whether these sky-high prices truly reflected the underlying value of the companies. This uncertainty led to a wave of profit-taking, as some decided it was time to lock in gains before any potential downturn. The mood shifted from euphoria to caution almost overnight. The AI boom was both the engine of remarkable growth and a source of significant market vulnerability. While it fueled optimism and innovation, it also introduced new risks that the market had to grapple with. Any jitters in the sector had outsized effects, sending ripples through the broader market. As the year ended, caution became the prevailing sentiment, with investors closely watching every move in the AI space for signs of trouble or opportunity. Despite these nerves, AI remained the dominant theme, continuing to reshape market dynamics and influence investment strategies across industries. The promise of AI-driven transformation kept hope alive, even as uncertainty lingered. The worries that surfaced were a natural response to such rapid gains, as the market searched for a more sustainable sense of value. Investors and analysts alike debated how to separate genuine innovation from speculative excess. The process of finding balance in tech valuations was far from over and would continue well into the new year. Market participants braced for more volatility, knowing that the search for equilibrium would shape the months ahead. Ultimately, the story of 2025 was inseparable from the rise and the risks of AI. As technology continued to evolve, so too did the hopes and fears of investors, ensuring that AI would remain at the heart of the financial conversation. The U.S. Federal Reserve's shift to easier money was a major force behind 2025's market rally. Lower interest rates made borrowing cheaper, spurring investment and economic growth. This environment especially benefited tech and AI firms, which rely on funding for innovation. The combination of cheap money and AI excitement created a perfect storm for stocks. Rising prices fueled more optimism, attracting even more investment. The Fed's policy was the fuel. AI was the spark. Investors watched the Fed closely, and December meeting minutes hinted at more rate cuts if inflation cooled. The prospect of continued support boosted confidence heading into 2026. For markets used to this helping hand, the Fed's stance was a foundation of optimism. Even with end-of-year jitters, the supportive environment looked set to continue. The rally's momentum was built on both policy and innovation. Despite a quiet finish, 2025's global stock market report card was stellar. Major indices posted spectacular growth, driven by powerful momentum. Asia led the way. South Korea's Kospi soared 75%, reflecting a strong export recovery. Hong Kong's Hang Seng rebounded 28%, and Tokyo's Nikkei gained over 26%. These results signaled widespread optimism and economic healing. U.S. markets also saw solid gains, lifted by tech and Fed policy. The rally was global, not isolated, showing interconnected economic improvement. Minor year-end dips were insignificant against such annual gains. Investors who stayed the course were handsomely rewarded. 2025 will be remembered for its powerful, sustained rally, not its quiet ending. The year restored significant value to markets worldwide. The big picture was one of overwhelming success. As the year closed, China delivered a positive surprise. Factory activity ticked up. This small increase suggested stabilization in the world's second-largest economy. China's health matters globally as it drives demand and smooths supply chains. The data offered a hopeful counterpoint to cautious market sentiment. It hinted at improving fundamentals that could support future growth. For investors, this was a constructive sign heading into 2026. The timing allowed 2025 to end on a more optimistic note. It was a reminder that real economic progress continues beyond market headlines. December 31, 2025, told a tale of two markets moving in opposite directions. Stocks ended a fantastic year with a quiet pause, while silver plunged after a record run. The big story was the year's gains, not the day's small moves. Silver's drop was classic profit-taking, amplified by thin trading. The quiet in stocks and the slide in silver were connected. Confidence in equities drew money from safe havens. These moves were natural adjustments, not signs of crisis. The final day was about balancing books and preparing for the year ahead. 2025's legacy was a powerful rally, especially in tech. The curtain closed on a year of remarkable growth, setting the stage for 2026.